All right, ladies and gentlemen, welcome back to Acquire and Operating Micro SaaS Firms. Kale here, holding it down. We're going to dive into the final cut of issue 20. So we've got some musings ahead, and man, I went deep on this. So, and admittedly, some of the thinking is a little bit half baked. I wanted to get something out there before we head into the weekend. But the topic here is multiple arbitrage in micro SaaS. So some very technical jargon there. Multiple meaning the premium that investors are willing to pay, which is typically a function of our world of ARR or of EBITDA or net income. So figure you have a SaaS business that's doing $1 million, investors might be willing to pay 3 times $1 million or $3 million to acquire that business. And that's multiples are a function of discounted cash flows, where you can, like, I guess a multiple starts to emerge after you run enough DCF models. So folks will skip that fun work and just kind of index toward the heuristic of a multiple. And also, I guess, EBITDA, same thought process applies. And so there's a lot of data around publics. There is not nearly as much data, for obvious reasons, around private company transactions. But what was generally, and I guess let's dive in. So here I'm going to share my screen and take you through. I've got some juicy charts here and some other stuff. But generally speaking, so in terms of how we're going to organize our thought process today, so we're going to talk about conventional playbooks and lower middle market private equity, which is usually 5 or 10 million plus. Well, once we uncover these dynamics, we'll try to answer the question whether these dynamics translate to micro SaaS. And then we'll take a closer look at multiple benchmarks and privates and try to glean what we can as kind of a starting point. And then we'll, I guess, contrast that with multiple benchmarks and micro SaaS where the data is even more limited. And then we will reach some conclusions. So let's jump on in. All right. So one of the greatest playbooks for wealth or value creation ever is like the down the middle home run, lower middle market private equity SaaS buyout strategy. Say that 5 times fast. But generally speaking, and we'll just look at this table to I guess, call out or highlight the point. You'll have a firm buy a $5 million ARR SaaS business, which is typically identified as subscale, meaning they've underpenetrated the market, they haven't professionalized the business, there's efficiency gains to be had, et cetera. But all to say the business is doing about 5 million in ARR, and these usually trade. And this assumes very conservative growth. So it's like, hey, we got to $5 million and we're kind of just here, we're plateaued. These usually trade at a 3.5x multiple. So we buy, 5 times 3.5, that valuation is going to land us at about 17.5 million. We then take possession of the business, we improve a lot of stuff, but most of it's kind of fixated on growth. So we might not touch too much around profit margin. We probably just need to demonstrate line of sight towards cash flow positive, but we're going to take a $5 million thing and grow it to a $10 million thing, which now trades at a 6.5x. So growth is a factor, but what we're really talking about right now is ARR category. So we went from 5 million to 10 million, and now all of a sudden we can sell it at a 6.5. Holy shit, what does that mean? That means that our return, which is just very back of the napkin, this assumes an all cash deal. Obviously, the calculus changes a ton when you include debt or leverage, right? It's kind of the definition of leverage. But we took 17.5 million bucks, we turned it into 65 million bucks, right? So our return is just shy of 50 million, $47.5 million, which money on invested capital or cash on cash is 3.7x. That is awesome, right? That is like home run buyout, SaaS buyout, lower middle market. We made a ton of money. The multiple or the MOIC is really interesting. And away we go. So that's the playbook. And that's created so much wealth. It's scary. So what we need to think about now is that when we're talking about, or I guess the question is like, all right, and this is kind of a setup. We're not going to answer the question here, but it's like, do these dynamics translate to micro SaaS? And so for us, it's very important to note that when we acquire these firms, right, like there's some assumptions, right? The first is that they're bootstrapped. So margin expansion is tough. It's like these companies are ran on a shoestring, a lot of duct tape, a lot of bubble gum, and the founder is likely technical. That means they're product centric. They have an engineering competence. So we acquire these businesses, and the competence that we bring to the table is go to market. So it's like, hey, we're going to, and almost all these companies have reached a plateau. You ask them how they're growing. It's like, hey, people spread the word. We have happy users. Other people come to our website, they click buy. There's a lot of product-led growth, et cetera. So we come in and it's our job to establish one productive acquisition or distribution channel. So maybe it's cold outbound, maybe we get content and SEO going, maybe paid ads are profitable. But usually we try to establish one productive distribution channel. And power law applies here, where that first, it's kind of like product channel fit is what it's often referred to. But it's like, all right, we get one thing going, that's probably, and we would test all of them to kind of compare relatively which is the most productive. But hypothetically, one of your distribution channels is going to yield, there's power law, right? So 80% of your results are going to come from one channel. So we want to get one going. So that's how we generate organic growth. And again, back to context is like, how do we want to take something that was generating 250K in ARR and grow it to 500K ARR. And they're all going to trade at 3. Ideally, we can buy in lower than a 3X, but the way we're going to create value is 3 times 250 is way less than 3 times 500 or 750. So we're just going to organically grow the business. We're not relying too much on multiple expansion or multiple arbitrage, as it's often referred to. The big value driver is increasing the base, which in our case is ARR. It's also worth noting that Micro SaaS categories by default are niche. They cater to niches typically because they're not as competitive. That's where you get these little sustainable, kind of smaller revenue businesses that are very, very profitable, which gets us very excited. The challenge is that they're small, so you got to do a lot of them to kind of get to a place where it's an interesting strategy. We'll touch on that when we come back. But back to the assumption around Microsoft being mostly composed of niche players. That means that the competition is very fragmented. Well, that means that there's probably an opportunity to consolidate these fragmented competitors into a single entity and create similar growth, right? You have a 250K business that caters to the same audience. You buy a 500K business, or let's say 750K business that caters to the same audience. Oh my God, now you're generating $1 million. And that growth is, of course, inorganic. But the bottom line is that top line revenue is what we're trying to do. And I'm going to write a lot about this, but there's a lot of thought process around margin expansion. And we think about the atomic unit, or said another way, what's like the minimum viable operating team that we can install that can manage a certain threshold of MRR. So let's say, as an example, a team has 10 contributors, some are part-time, maybe some are full-time, and the business is generating 300K. It's like, okay, they're doing, and my math is going to be a little off the cuff here, so forgive me, but it's like, all right, that's about 30K in MRR per, oh God, I'm going to totally unwind that because I don't want to dive into an example off the cuff here. But generally speaking, we can reduce staff and preserve the same amount of MRR productivity or increase the amount of MRR productivity, AKA improve the operating leverage that's present within the business. And that is by implementing an atomic unit. So cutting the bloat and assuming that these individuals are very systems driven, very technology oriented. There's a ton of horsepower behind them. So they punch like 5 employees. And the benefit of that is that you have a fewer headcount to manage, which really is fatiguing for management. So we call it kind of management or leadership load. The more humans you have to manage, the more alignment you have to create, the more consensus, the more kind of emotional dynamics that you need to manage. And it's very fatiguing, which takes you away from the task at hand, which is growing revenue, delighting customers, et cetera. So just to kind of, I guess to finish the point there, we rely less on margin expansion, which is a function of cutting costs. Because again, these businesses are bootstrapped. So if we look at a very simple example here to kind of pull everything together, we buy a business that's doing 400K in ARR. We buy it at a 2X multiple. We spend 800 grand. We then grow it to 800K ARR, and we can now sell it at like a 3 or a 3.5. Oh my goodness, we can sell it for 2.8 million. The cash on, or the general return there, cash on cash is 2 million. And then the MOIC is the general return is 2 million. And that is like kind of the cash equivalent. And then the money on invested capital is 3.5x. So again, this are some important considerations. This doesn't factor debt, which changes the calculus a lot. And it also doesn't affect time horizon. So speed is rewarded. And the big dimension for that is IRR, because that takes into account the time value of money. So you might look at this and be like, well, Kale, go focus on bigger deals, right? Instead of generating what do we say below 2 million, let's go generate 47.5. And it seems like this is all kind of comparable. The edge here is that we can move faster and we can make up for that discrepancy via deal volume. So the thought process is we can have a smaller operation, a smaller outfit, which is easier to lead and I guess manage performance around. And it should generate outsized returns, especially when you include debt. And if we do enough of these deals, we'll start to get to thresholds on an aggregate basis as a function of like cash returns that start to get very, very interesting. So that's just kind of generally like, okay, just to backtrack, and again, I'm bouncing around. It's Friday. I'm a little fatigued, and this is a heady topic that I really dove deep into. But you've got kind of conventional private equity playbooks. Then we're starting to think about micro SaaS and what we're trying to do. And so before we can, I guess, look at micro SaaS, we want to just look at private company benchmarks, period, and be like, okay, like, is there a premium for ARR category? Because it's widely held that the larger a business is, the more stable it is. And investors are willing to pay a premium for that. So said another way, a $10 million business is worth more than a $5 million business because a 10 million more business is kind of quote unquote more stable, more enduring. I am of the belief that that tendency from investors is going away, where now it's like, I don't care what the ARR is. You know, if it has 3 or 4 years of enduring profit margin, that's a pretty stable business. Who cares what ARR threshold it's at? But regardless, we want to look at benchmarks in privates to start try and build conviction that, okay, in the private markets, there is this premium on ARR category. Because again, that would kind of lend towards a strategy where it's like, we just need to achieve an ARR category. Or we should fixate on achieving an ARR category because it's going to create a multiple expansion more so than anything else, more so than growth rate, more so than profit margin, et cetera. So put simply, when we buy a 500K business, our number one goal is to get it to $1 million. Obviously, there's going to be a growth rate that's implied there, but we want to get it to $1 million as soon as possible because that's going to create a bigger multiple, and away we go. Happy days. So I think what we can say, and I guess as a disclaimer, private market data is notoriously opaque, right? Publics, you want to know, you know, their exchanges, everything's public. There's so much information on these companies, growth, revenues, employees, operating costs, et cetera. In private companies, there's zilch. So all of these benchmarks are a function of, I guess, models that are ran against, I guess, statistics that are identified in publics, or they're surveys to private companies. And obviously surveys, you know, there's subjectivity there, and there's like I guess an honesty component too, where I think people are probably more inclined to report better than realistic performance. So I think what we can say for sure is that when you get, or I guess what we can have some confidence around, not say for sure, that is not what I meant to say, is that when you get to $1 million, it's decently likely that you're going to unlock 5x multiples. So if we look here, and this is kind of an amalgamation, I included a section at the bottom here where you can go deep on valuations and the mechanics and how bottom-up valuations work. You can look at bench rates and comparables and how those types of, I guess, data points are derived. But these are SaaS valuation multiples that are broken down by segment. And I just kind of consolidated this into an average, a min, and a max. So 1 to 5 million, average is 5.69. 6 to 10 million. So now we're in a different ARR category, if you will, is 6.7. And then 10 to 75 million is at 8.28. So what's important to note is that this was over the course of 2023, and we're kind of in the midst of a huge correction right now around valuations and around multiples, where investors are no longer rewarding kind of this growth at all costs because debt's more expensive, right? Interest rates, there's so many macro conditions that have gone into, I guess, punishing growth at all costs because it's not sustainable. And I guess there isn't cheap capital to kind of prop up those companies. So now the emphasis is switching towards, which is kind of like, yeah, duh, but it's like, sustainable, enduring, capital efficient growth. So we should probably apply a discount to what these multiples look like in kind of current state market conditions. But needless to say, it's like, all right, all of these multiples are above a 5. And we're in this world, we're looking at 1 to 75. And we can say on average that the multiples are getting bigger as the ARR category increases. But this table doesn't factor anything besides our ARR category. So we're going to step in and we're going to look at some tables that do, because our conclusions change a little bit. So here you can see a different table. And this one, again, is a function of kind of like a weird model that uses publics and then uses public or private company surveys, et cetera. But here we see structural decline in multiples as ARR category increases. It's like, oh shit, that's exactly the opposite of the kind of the conclusion that we just drew from the last chart. But what's interesting is that this includes growth. So here, what we see is that growth decreases as ARR category goes up. So a natural conclusion right here would be, okay, so in reality, growth rate commands more of a premium than ARR category, right? There's a structural decline in multiple as ARR category increases, but there's also a structural decline in growth rate. So here we start to appreciate that, like, okay, ARR category for sure is not the name of the game, right? That it's like, if you're going to optimize for one thing, it's not ARR category, it's probably growth. And I think this all kind of culminates, and it's so funny when there are things like the rule of 40, which is that your growth rate plus your profit margin should equal 40% of revenues. And that's kind of the holy grail in SaaS, and it has been forever. And it's like the most trite but true thing ever. And so it's kind of disappointing to go through all this kind of deep meta thinking to kind of achieve the same conclusions. But I guess those enduring conclusions are that way for a reason, right? Like they stand the test of time. So I think my conclusions here are that all to say, rule of 40 reigns supreme, right? So growth and profitability is the number one thing that investors reward on average, is, I guess specific to the B2B SaaS buyout world, but I think probably in general that's accurate. And ARR category is kind of a nice to have, but it's very likely not in your top three things, right? So we're starting to lose a lot of confidence around ARR category and multiple arbitrage or expansion as a function of ARR category. So that's kind of where we're leading so far, right? And that's like, all right, we looked at, or we articulated what is kind of conventional wisdom in lower middle market private equity. We then looked at some benchmarks and some data to see if this is accurate. And I'm not sure that it is, period. And I think probably more importantly, other attributes like growth and probably profit margin are going to be more rewarded than ARR category alone. But this is private markets, and we're playing even below that, right? We're playing in Micro SaaS, which is sub $1 million. I think everyone would agree that that's micro. So now when we look at, and I'll zoom in on this one because it's a little tough to read, but acquire.com is probably considered the best marketplace for micro SaaS companies at this stage. And they did benchmarks from 2023. And what we can see here, and again, as I mentioned, like micro SaaS companies, kind of the heuristic is that they trade at a 3x of revenue. And here we can say, okay, again, structural decline in multiple as revenues grow. So sub 100K is an average of 3.4x, 100K to 1 million, which is a pretty big tranche, admittedly, is 3.1x. And then 1 million plus is 2.2x. So what's important to note is that there's almost no north of $1 million, like $1 million deals are and above are very thinly represented on the acquire marketplace. So we got to be very careful how much we lean on these benchmarks to draw conclusions. What we can say is nothing's really trading on average above a 3.5. So back to our thought process around like, okay, the first table, when you're in the $1 million wheelhouse and above, and it goes up to 75, which is a huge variance. But when you're in that $1 million wheelhouse, you're probably trading at a 5x. What we can say generally is that if you're below 1 million, you're probably trading at a 3.5x. Again, this table doesn't include growth. It doesn't include profitability, any of that kind of stuff. But generally, I think we can feel confident that, like, all right, you get to $1 million, you're probably starting to play at the 5x game. Below that, you're playing at a 3-ish game. And then again, these benchmarks need to be taken with, a couple handfuls of salt because it doesn't factor growth and there's almost no $1 million deals here. So we're doing the best we can with what we got. And at this point, it's like, all right, the data's okay. And then I think there's kind of the law of diminishing returns, right? Like we want to just probably understand this to a place where we feel conviction in like our directional perspective, but it doesn't need to be airtight, Loctite to inform our activities. So at this point, and I've kind of stated some of my conclusions up until now, but if we synthesize all the findings, ARR category, and then we'll really bring it back. ARR category is probably like the fourth or fifth most important dimension to unlocking new multiples or multiple arbitrage. I can say it's very distantly behind growth rate, profitability, which you could accumulate those into a single metric, which is maybe kind of splitting the atom there towards rule of 40. So it's like if you can get a business towards cumulative 40% which is profit plus growth, that's going to unlock multiples more than anything. So fixate on that. And that's probably the North Star metric for any business that you acquire. And if you can achieve a new ARR category, that's kind of gravy and probably like a natural outcome that's kind of baked into performance and achievement of the other metrics that I had already mentioned. All right, my God, we've covered a lot, and this is heady. And again, apologies, I'm a little fatigued, so I don't feel as articulate as I typically can be. So again, I'm comfortable with those directional conclusions. So I think what most importantly, it's kind of like, all right, well, so now what? So I think the most important questions to answer is in the context of it's hard to grow a business organically. So, and we know that ARR category is rewarded to a degree. So instead of trying to grow one entity organically to achieve a new ARR category, maybe we acquire multiple, we roll them up, right? We acquire complementary assets, we roll them up under one roof, and we achieve a different ARR category, which hypothetically is easier, but acquisitions are tough, M&A is tough, inorganic growth is tough, integration is tough. So maybe, they're equally difficult, but it's like, hey, we could just buy a few, roll them into one entity, exploit economies of scale, remove cost redundancies, et cetera. And that's maybe a more efficient way to generate multiple expansion. So I think the question just the two questions that stand out are, what is our confidence level regarding generating compelling growth and or profitability via a roll-up that places us in the 1 million ARR category? Or is it easier to generate breakout growth or significant profitability in a single entity? So say something that's at 500K ARR versus two entities that are combined at 1 million ARR, because that second scenario should yield similar multiple expansion. So that's kind of what I'm noodling on for now. And I think I'll leave it at that. I think one final comment is I think I'm definitely indexing towards generating breakout growth at a single entity is probably a little bit easier than a roll up. It's perhaps less defensible in the long, like obviously this is riddled with trade-offs, but that's generally kind of where I'm landing. I know for sure that Rule of 40 is mission critical and probably your North Star metric. And then MRR per employee or per contributor is probably the root there, right? So it's like, we need to generate optimal profitability per contributor, and we need to reduce the cognitive load of switching between companies. And so the path forward that's probably the most likely to yield success is as few assets, as few atomic units or operating kind of levers human beings spread across kind of pure play assets that punch way above their weight class, so that we are optimizing for MRR per employee and also, the least amount of management load so that we can move fast. I'll leave it at that. All right. Thanks for riding along on this one. Admittedly, a little choppy here, but hopefully this is useful as you start to kind of muddle through your thesis, your value creation strategy, portfolio construction, some of the super meta stuff that players in our world need to consider and sharpen their pencil around. For the love of the game, I'll see you next week. Cheers.